Bobbie Goldie, and welcome to What's Brewing, where we dive into industry trends and IAT's insurance solutions. After you leave this webinar, you'll see a survey in your browser where you can provide feedback on this webinar, but more importantly, on what you'd like to hear from IAT. Today's guest is John Passaro. John is the EVP of Management Liability and has more than 30 years experience in the industry, including extensive experience in management liability. He joined IAT in 2019, signaling our entry into the management liability space. And boy, what a ride has it been. John, thank you so much for joining us today.
Morning, Bobbie.
So let's talk about, we're just going to dive into what everybody's sitting on the edge of their seat for, okay? So let's talk about some of the issues that we're seeing in this very dynamic marketplace. Like what's going on with the plaintiff's bar? Everybody wants to know.
It's very interesting when you look at management liability and all the different parts that go along with it. Obviously, claims is a big part, and it never ceases to amaze, I think, anyone in the management liability field, the various ways the plaintiff's bar figures to file claims. We've actually had a number of claims come in, and they're not large claims, but we have them come in typically on an auto dealer, for example, where these firms will scour the websites and they will look for auto dealers' websites that are not compliant for the visually impaired. And they will file a suit saying it's not fully up to compliance for all ADA regulations. And those typically settle for very small amounts, and they're more nuisance claims than anything. But it's just another way they've found to try to get to the, call it the deep pockets of an insurance carrier or an insured.
I'd like to shift over to COVID. Let's talk a little bit about COVID and post-COVID and some of the intrepidations as management liability underwriter that you were seeing, and then I'd like to hit upon PPP loans.
There were a lot of uncertainties when we were launching the business, whether it was at the end of COVID, coming out of COVID. That's still a kind of a gray line, but there were a lot of timing. Yeah, the timing was very interesting, but there were a number of things we were concerned about. Some were return to work, how many people would force their employees to come back, who would not, work from home, were there hybrid schedules, how many people that were laid off during COVID would be brought back. During that time, there were a lot of social injustice issues going on. So there were multiple things that occurred during COVID. It was like the perfect storm of issues that could affect the corporation's ability to manage and how they were viewed and how they managed through all those issues. In post-COVID, or as we were coming out of COVID, one of the things we saw that was actually a good sign, there were a lot of companies that grew pretty quickly. They hired a lot of people back, particularly in the hospitality industry and areas like that, depending upon where they were in the country. But a lot of businesses, I'll say, started to thrive quicker than we thought they would, which was a good sign. One of the areas we were concerned about was in the PPP loans. A lot of organizations got money from the government to subsidize and help them get through the pandemic. The good news is on the accounts or the businesses that we looked at, probably about 80 to 85% of those had their debt covenants with the PPP loans waived, and they were forgiven, which was a good thing. But from a management liability perspective, an area we were concerned about was the company before COVID having trouble? Then they got these PPP loans, which stabilized their business, and not much was happening. So it was kind of just a straight line of, we'll call it steady time. And then post-COVID, those loans weren't there. So were they able to grow their business and not be dependent upon the loans that helped them get through that time? And did they start to go up, or did they start to continue back to the trend they were before COVID, where they weren't making money, they were having profitability issues? And that loan almost acted as a shield, or it covered up the fact that they weren't going to be profitable. So those were things we really had to dig into from an underwriting perspective. And I will tell you that, call it a year and a half later, very pleased to see that a lot of the businesses or the type of industry classes we look at are actually doing well for the most part.
So what about claims for discrimination and harassment? Have you seen those trending up or trending downwards?
That's interesting, Bobbie, because during COVID, especially at the height of it, there were a lot of social injustice issues that were going on. And a lot of companies, whether you're talking about global publicly traded companies down to small private companies. Made a lot of promises from a diversity and inclusion standpoint on improving things within their own organizations and within their communities. What we've seen from a claims perspective after COVID and after some of these social injustice issues have, I don't say subsided, but have died down a little. A lot of companies promised a lot of things, but did not actually institute those policies, whether it was broadening the spectrum of the type of people they hired, whether it was people of color or women or what have you. And what's happened is we've seen claims come in where these companies made a lot of promises, but they actually didn't execute on those. So it's something we look at, and we do ask those questions in our underwriting.
Now, tying into that, corporate governance, what do you see going on in the corporate governance space?
For corporate governance, it's kind of all over the place. So we talked a little bit about diversity and inclusion. That's part of corporate governance. We talked a little bit earlier about companies managing, we'll call their debt and their debt covenants and how they are navigating through the post-pandemic and finding different ways to increase their revenue streams. And then overall, we found that return to work and how employees view the way their boards and their management are running their companies, we've seen some pushback there where you have people that don't want to come back at all, people that want a hybrid, people that want to come back full time. So a lot of companies have had to test and adjust for that. And some of it is industry specific, some of it is, we'll call it, more philosophical differences. So you heard about the quiet quit, and
Yes.
We've seen some of that in the industry. So when we underwrite employment practices, one of the things we pay a lot of attention to is involuntary and voluntary turnover. When you see a lot of voluntary turnover in an organization, that can tend to be an indicator of the quiet quitting, as they call it. It can be for other reasons as well. But when you see a lot of involuntary turnover, that can be a sign of the company struggling and they brought people back, but maybe they brought them back too soon, or their organization wasn't in the best place pre-pandemic and they've continued to struggle to get back. So we look at all those factors and a number of other factors in our underwriting.
As you're talking through this, I can't imagine being, an executive in today's day and age and having to manage through things that you had no experience with, right? The world stopped for a pandemic, and now all of a sudden, as an organization, you're making all these decisions that you never thought you would have to, and you just keep going through these, and it blows my mind. So I would be remiss without talking about the economy now. How has the economy impacted, your or your product lines?
Well, management liability, particularly directors and officers, is based on the management and board governance of an organization. So it has a large effect on us, but I think it differs by industry class. Certain industries post-pandemic have really come back and seem to be doing very well. Others are still struggling. And we really have to look at this on an underwriting basis from an individual risk perspective. Even if it's a class of business that tends to be doing well post-pandemic, we still are going to underwrite that risk because there can be other things. Did they acquire a lot of debt? Are they meeting their debt covenants? All those type of things go in. A big thing we look at is board experience. A lot of companies lost board members over the last couple of years, and they put new board members on, but are they the right board members? Do they have the qualifications, or were they just filling spots? So we always look for turnover. We look for changes in auditors. Are there financial disagreements between the organization and how they're governing versus how the auditors see their financials performing? So there's a number of things. You have social inflation, you have regular inflation that affect these products. So there's a number of different factors that we're constantly viewing and underwriting to.
Yeah, cost of goods sold for some organizations. It's a big one. All right. So, are there certain states that you may pay more attention to for a number of reasons? Are all states created equally?
All states are definitely not created equal. I think there's a few states that have a much more litigious, or it's a tougher environment for corporations to operate in. And when I think of those, I think of California, I think of New Jersey, Louisiana. They're couple other, but those tend to be the tougher states, particularly in employment practices liability when you look at that. And we actually write a lot of that business in those states, but we just have to look at a few other factors when we're doing that, just to make sure we're putting the right terms and conditions out to make sure that we're protecting the corporation the right way.
Thank you. Okay, so we're just going to easily segue into your appetite. So you mentioned that you write business in these states, so that's interesting. So let's talk a little bit more about your appetite and what your sweet spot is and where you're eager to grow.
So our organization only writes or insures private and not-for-profit organizations. So that's a very large span of the types of entities we could be underwriting. I don't want to necessarily say we have a sweet spot in one particular industry, but our average size account is in that 250 million in assets to about $1 billion in assets. We have organizations, a number of them much smaller than that, and we have a number of them that are much larger than that, but always private or not-for-profit. Some of the industry classes we tend to do very well in, and we've grown significantly in, our hospitality, the restaurant business. And restaurants, it can be a single location, white linen type restaurant, or we have a number of insureds that have several hundred franchisees that are part of that organization. We write or underwrite and insure a large number of auto dealers. We also insure a fair number of higher education organizations, healthcare, not large hospitals, but more doctors groups, medical groups, urgent care facilities, things like that. A lot of corporate real estate accounts we have. We also write a large number of commercial real estate accounts. We're not really adverse to many things. We've got a broad appetite. There's certain industry classes we stay away from. Anything crypto, marijuana, tobacco, those are excluded classes for us to underwrite. But in general, when you look at the private and not-for-profit world, there are literally millions of organizations within the United States that we have the opportunity to possibly look at as insureds.
All right. So with everything going on in our economy, I got to ask about construction. How about that industry?
We write a fair number of big GC type organizations, specialty contractors, very similar to our surety organization. We do like that business, including contractors that do a lot of government projects and so forth. It tends to be a very profitable group and or class of business, and we underwrite to that specific niche.
Nice, nice. So you spoke about your coverages for private and not-for-profit organizations. Do you mind hitting on the products a little bit more and the status briefly?
Sure. Our products from a primary basis are admitted, and that's directors and officers liability, employment practices liability, fiduciary liability, and commercial crime. On an excess basis, we are on a non-admitted basis, and our products are directors and officers, employment practices, and fiduciary liability.
So it's been interesting being at IAT the last few years and seeing what your group has done. It's a testament to the leadership as well as the great folks that you brought in. In a market that's extremely saturated, your team has made a name for themselves. So congratulations on that. So what has made your team so successful, and what sets IAT apart from the competition?
What's made the management liability division successful at IAT, without question, are the people. And not only from the people that came aboard as we built the group, but from the leadership that's here, the support we've gotten all along the way, from our broker partners all along the way helping us get set up. And the people we've hired, the average tenure is about 12 years. We have some individuals that have less experience, but the average is about that time. And we really have built what I would call best-in-class underwriting group. And we've had a very successful first 2 years. It all comes down to the people that we have. And that's not just the underwriters. It's our claims team. It's our product folks. It's our account management group. It's our processing folks and all the other different parts of the enterprise at IAT. Everyone, even though they weren't involved on a day-to-day basis, pitched in helped us, get this group up off the ground.
So it seems pretty collaborative. What about, IAT is a specialty company and we're very niche. So when you're thinking of your competitors and then you think of your relationships with your brokers, what sets you apart with them?
We have listened to our brokers. We are a wholesale only market. We deal with hundreds of different brokers around the country. And we really sat down and asked them, what would make us different? What do you see as a market that differentiates themselves from the others? And we took that and we embraced it. And I think our responsiveness, I mentioned before, our willingness to listen and be flexible or think outside the box, and having the right people at the point of sale. And again, not just the underwriters, but the claims folks, the products folks, it's made all the difference.
Yeah. And it goes back to what IAT stands for, Insurance Answers Together. And you actually listen to your customers. It's very impressive. It's been a fabulous 2 years. I still, sit on the sidelines just being amazed by it.
Thank you.
So John, thank you so much for joining me today. I really appreciate the conversation and all the insights that you brought out for our folks. And I can't wait to do it again.
Thanks for having me, Bobbie.
And thank you for joining me today. As I mentioned at the beginning of the webinar, there's going to be a little survey that's going to pop up in your browser. Please provide us with your feedback so that we can continue to share what you'd like to learn about more. I'm Bobbie Goldie with What's Brewing. We'll see you next time.